All right, welcome back. Welcome to Sharpen Your Edge and Learn to Trade Fearlessly. We're actually in session 14 right now, and we're going to go into volume price analysis, chapter 4, and we're going to start with first principles here. And I'm going to do a lot of reading from the book, which is best. So you're going to hear Anne's voice, basically. So when you hear me say I, it is Anne who's actually talking. So let's go ahead and jump into this. So in this chapter, Anne wants to start with some basic tenets for volume price analysis, VPA. But first of all, let me set out what she believes are the guiding principles in order to be consistently successful as a trader using this approach. These are the principles that she uses every day and have been developed over 20 years. These are not rules, but simply guiding principles to help put the rest of what you're about to learn from this course into context. So let's get into the first principles. First principle, number one. The first principle to understand is that learning to read charts using VPA is an art, it's not a science. It is not a technique that lends itself easily to automation or software either. Although it does take a little while to become proficient, you'll be rewarded for your effort and time. It can then be applied to any instrument in any market in any time frame. And the reason software doesn't work with VPA is simply because most of the analysis is subjective. You're comparing and analyzing price behavior against the associated volume, looking for confirmations or anomalies, while at the same time comparing volume to judge its strength or weakness in the context of volume history. And a software program, it just doesn't have the subjectivity in its decision making, and really it can't work. And the other advantage to learning this is that once you have learned this technique, it's effectively free to use the rest of your life. Principle 2, patience. The financial markets are like a super tanker. It does not just stop and turn on a dime. The market always has momentum and will almost always continue beyond the candle or candle pattern, which is signaling a potential reversal or an anomaly. Now, when Ann first started, she always became very excited whenever she saw a trading signal and would enter a position immediately, only to see the market continue on for a while before the signal was validated with the market duly changing course. The reason for this is very simple to understand once you begin to think about what is happening in each price bar and in terms of the reality of the market. So let me use an analogy here to help illustrate the point. The analogy is of a summer shower of rain. The sun is shining, then there is a change, the clouds blow in, and in a few minutes, the rain begins to fall lightly at first, then heavier, before slowing again and finally stopping. After a few minutes, the sun comes out again and starts drying up the rain. This analogy gives a nice visual picture of what actually happens when a price reversal occurs. Let's take a look at an example of a downtrend where the market has been selling off over a period of several down candles. At this point, we begin to see signs of potential buying coming into the market. The sellers are being overwhelmed by the buyers. However, they are not all overwhelmed immediately within the price action of the candle. Some sellers continue to hang on, believing that the market is going to move lower. Any of us done that? The market does move a little lower, but then starts to tick higher, and some more sellers are frightened out of the market. The market then drops back lower once again before recovering, and in doing so, shakes out the more obstinate sellers. Finally, the market is ready to move higher, having mopped up the last remnants of selling. Now, the market rarely stops dead and reverses. It almost always takes time for all the sellers or all the buyers to be, quote, mopped up. And it is this constant whipsawing which creates the sideways congestion price zones we often see after an extended trend move, higher or lower. This is where price support and resistance become so powerful, and which are also key elements of VPA. It's number 3, principle number 3. It's all relative. The analysis of volume is all relative, and Anne only came to this conclusion once she stopped worrying about her volume feed. When she first started, she became obsessed with trying to understand every aspect of the data. Where did it come from? How was the data collected? Was it accurate? How did it compare to other feeds? And was there something better that would give her more accurate signals, and so on? After spending many months trying to compare the feeds, Anne soon realized there was nothing to be gained from worrying about minor imperfections or discrepancies. As she wrote earlier, trading in VPA is an art, not a science. Data feeds will vary from broker to broker and platform to platform, thereby creating slightly different candle patterns. If you compare a chart from one broker with another of the same instrument and time frame, then the chances are you will have two different candlesticks. And the reason for this is very straightforward. It's because the close of the candle will depend on a variety of things, not least the clock speed of your computer, where you are in the world, and what time during the session the closing price is triggered. They all vary. Principle number 4, practice makes perfect. Now, it takes time to become proficient in any skill, right? But once learned, it's never forgotten. The trading techniques you'll learn from this coursework, it works in all time frames and are equally valid, whether you are a speculator or an investor. As an investor, you may be looking for a buy and hold over months, so you'll be considering the longer term charts of days and weeks. Alternately, you may be an intraday scalper trader like us using VPA on tick charts or fast time frames as we do. So just take your time and don't be impatient. It's worth the time and effort you invest. And after a few weeks or months, you'll be surprised at how quickly you can suddenly start to interpret and forecast every twist and turn of the market. Principle number 5. VPA is only part of the story. We always use a variety of other techniques to confirm the picture and provide additional validation. The most important of these are support and resistance, which we do with our demand and with our zone system. For the reasons Anne outlined in principle number 2, this is where the market is pausing and executing its mopping up operations before reversing. Alternately, it may simply be a pause point in a longer term trend, which will then be validated by our volume analysis. A breakout from one of these regions of consolidation coupled with volume is always a strong signal. Trends are equally important as are price pattern analysis, all part of the art form, which is technical analysis. And principle number 6, is it validated or anomaly? So validation or anomaly. In using VPA as our analytical approach, we're only ever looking for two things: whether the price has been validated by the volume or whether there is an anomaly with the price. If the price is validated, then that confirms a continuation of the price behavior. Let me read that again. If the price is validated, then that confirms a continuation of the price behavior. By contrast, if there is an anomaly, then this is sending a signal of a potential change. These are the only things we are constantly searching for in volume price analysis. So let's talk about validation or anomaly. Nothing else. So we're just talking about validation or anomaly, nothing else. And here are some examples of validation based on single bars before moving on to multiple bars and actual chart examples. Let me let somebody into the room. And again, I want to thank Brian for his creation of the charts on this. So first, we're going to talk about widespread candle with high volume. In this example of a widespread up candle with small wicks to top and bottom, the associated volume is well above average. So the volume is validating the price action. In this case, we have a market which is bullish and has risen strongly in the trading session, closing just below the high of the session. If this is a valid move, then we would expect to see the effort required to push the market higher reflected in the volume. Remember, this is also Wyckoff's third law of effect versus result. It takes effort for the market to rise and also takes effort for the market to fall. So if there have been large change in price in the session, then we expect to see this validated as a well above average volume bar, which we have. Therefore, in this case, the volume validates the price. And from this, we can assume two things. First, the price move is genuine and has not been manipulated by the market makers. And second, for the time being, the market is bullish. And until we see an anomaly signaled, then we can continue to maintain any long position that we may have in the market. And this is narrow spread candle, low volume. Now, this graphic is an example of a narrow spread candle accompanied by low volume. Now, in this case, the price has risen, but only marginally higher, and the spread of the candle is therefore very narrow. The wicks to the top and the bottom are once again small. The associated volume is well below average, and again, the question we have to ask ourselves is simple. Is the volume validating the price action? And the answer, once again, is yes. And the reason is, again, because of effect and result. In this case, the market has only risen in price by a small amount, and therefore we'd expect to see this reflected in the volume, which should also be low. After all, if effort and result validate one another, the effort required to move the market a few points higher, the result, should only warrant a small amount of effort, the volume. So once again, we have a true picture with the volume validating the price. Now, let's look at these two examples again, but this time as anomalies. Widespread candle, low volume. In this graphic, we have our first anomaly, which can be explained as follows. It is clear we have a widespread up candle, and if we follow Wyckoff's third rule, then this result should be matched by an equal amount of effort. What we have instead is a big result from little effort. This is an anomaly. After all, for a widespread up candle, we'd expect to see a high volume bar, but here we have a low volume bar. Now, immediately, alarm bells should start ringing since something is not right here. Next, narrow spread candle, high volume. Once again, this is a clear signal of a potential trap. The move higher is not a genuine move, but a trap move designed to suck traders into weak positions and also take out stops before reversing sharply and moving in the opposite direction. This is why VPA is so powerful. And once you have learned this skill, we'll wonder why you never discovered it before. Volume and price together reveal the truth behind market behavior in all its glory. In the example, we can see a narrow spread candle with high volume, which once again is another anomaly. As we saw earlier in another graphic, a small increase in the price result should only require a small increase in volume, effort, but this is not the case here. The small price increase has been generated by a huge amount of volume. So clearly something is not right. In fact, it's very wrong. Generally, we would expect to see the height of volume bar accompany a widespread candle with the volume driving the price higher. But in this case, the high volume has only resulted in a small rise in the price. This should be ringing off some bells. We know that most investors and traders tend to buy at the top, which in fact they should be selling, and sell at the bottom when they should be buying, something which the specialists and market makers are very well aware of in the psychology and makeup of most traders and investors. That is, they know that about us. All right, moving on. I want to explain how we use VPA with multiple candles in volume as opposed to single candles. The approach is identical to, or as we only ever look for two things. Is the volume confirming the price action, or is this an anomaly? So in this first example, we have a bullish trend developing in a rising market, which is obvious that rising prices are accompanied by rising volume, right? This is exactly what we would expect to see. And furthermore, having multiple volume bars also gives us a benchmark history against which to judge future volume bars. So if we were watching this price action live, this is what we would see happening on our chart. The first candle forms a narrow spread up candle and low volume, which is fine. The volume validates the price, no anomaly here. The second candle then begins to form, and on close inspection, we note the spread of this is wider than the first. Based on Wyckoff's rule, we expect to see greater volume than on the first bar, which is indeed the case. So the uptrend is valid. the volume has validated the price on both candles. By the time the third candle starts to form and closes with a spread which is wider than both the first and the second, we should expect a volume bar which reflects Wyckoff's third law of effort versus result. The third law, which states we have increased the result, price spread is wider than before, which should be matched by increased effort. Volume should be higher than on the previous candle, and so it is. Therefore, once again, the price action on the candle has been validated by the volume. But in addition to that simple observation, the three candles themselves are now validating the price trend. See how that works? So rising prices equal rising value. If the market is rising and we see rising volume associated with the move, then this is a valid move higher, supported by market sentiment and the specialists. In other words, the specialists and insiders are joining in the move, and we see this reflected in the volume. Moving on. Multiple bar validation in a downtrend. So I now want to examine the opposite and look at an example where we have a market which is falling, as in this graphic. In this case, the market is moving lower, and perhaps this is where some of the confusion starts for new VPA students and for new option students as well. As humans, we are all familiar with gravity and the concept that it takes effort for something to move higher. The rocket into space, a ball thrown into the air, all require effort to overcome the force of gravity. Now, as traders, these examples of gravity are fine in principle when the market is moving higher, as in our first example. Where these examples using gravity fail is when we look at markets which are falling, because here too we need rising effort, which is volume, for the market to fall. The market requires effort to both rise and fall, and it is easier to think in these terms. If the specialist, the big boys, are joining in the move, whether higher or lower, then this will be reflected in the volume bars. If they are joining a move higher, then the volume will also be rising. And equally, if they are joining a move lower, then the volume bar will also be rising in the same way. This is Wyckoff's third rule again, effort versus result. And whether the price action is higher or lower, then this rule applies. Looking at the four candles in this example, the first down candle opens and closes with a narrow spread. The associated volume is small, and therefore it validates the price action. The next bar opens and closes with a wider spread, but with higher volume than on the previous candle. So once again, the price action is valid. The third candle opens and closes with higher volume as we expect, and finally we come to our last candle, which is wider still, but the associated volume is also higher than all the previous candles. Once again, not only has volume validated each individual candle, it has also validated the group of four candles as a whole. So one of the questions really that hasn't been answered in either of these examples is this: is the volume buying or selling? And this is the next question we always ask ourselves as the market moves higher. Remember, there are only two risks in trading: the financial risk of the trade itself, and this is easy to quantify and manage using simple money management rules. The second risk is far more difficult to quantify, and this is the risk of the trade itself. And this is what VPA is all about. It allows you to quantify the risk on the trade using this analytical technique. And when combined with all the other techniques that we use, is immensely powerful, and even more so when you combine with analysis in multiple time frames. All right, let's talk about multiple bar anomalies in an uptrend. And, hopefully you're starting to see how the relationship between volume and spreads works to either validate the move or invalidate the move. So multiple bar anomalies in an uptrend. Here we have what appears to be a bullish trend, with the first narrow spread up candle accompanied by relatively low volume. This is fine, as the volume is validating the price and is in agreement. Now the second candle then forms, and on the close we have a slightly wider spread candle than the first, but with high volume. From experience and looking back at previous bars, this appears to be an anomaly. With high volume, we would expect to see a widespread candle. Instead, we only have a candle which is marginally wider in price spread than the previous candle. So something's wrong here, and alarm bells are now ringing. Now, remember Wyckoff's third law, effort versus result? Here, the effort, the volume, has not resulted in the correct result, the price. So we have an anomaly on one candle, which could be an early warning signal, and we should be paying attention. The third candle then forms and closes as a widespread up candle, but with volume which is lower than on the previous candle. Now, given the spread of the bar, it should be higher, not lower, and that's another warning signal. Now, the fourth candle then forms and closes as a very widespread up, but the volume is even lower. We now have several anomaly here on candles 2, 3, and 4. We should not be engaging in this trade. Okay, multiple bar anomalies in a downtrend. In this example, we have what is known as a price waterfall, where the market sells off sharply. We also call that falling knives if we have long wicks. The first candle open and closes and associated with low or relatively low volume, which is as we expect. We then start to see the anomalies beginning with the second price bar in the waterfall. The candle has closed with a marginally wider spread than the previous bar, but the volume bar is high or very high. What this is signaling is the market is clearly resistant to any move lower. After all, if this was not the case, the price spread would have been much wider to reflect the high volume. But this is not the case and is therefore an anomaly. And just as in the previous example, the alarm bells are now ringing. What is happening here is bearish sentiment is draining away, with the sellers now being met with buyers at this level. The market makers and specialists have seen the change in sentiment with the buyers coming in and are moving in themselves, buying the market at this price point. So those are our examples with and without anomalies. Now, to kind of wrap this up, this process can be broken down into 3 simple steps. First, step 1, micro. We analyze each price candle as it arrives and look for validation or anomaly using volume. You'll quickly develop a view on what is low, average, high, or very high volume just by considering the current bar against previous bars in the same time frame. Principle 2, macro. Analyze each price candle as it arrives against the context of the last few candles and look for validation of minor trends or possible minor reversals. And 3, global. Analyze the complete chart. Have a picture of where the price action is in terms of any longer-term trends. Is the price action at the possible top or bottom of a longer-term trend, or just in the middle? This is where support and resistance, candle patterns, and chart patterns all come into play, which we're going to cover in more detail next week. So in other words, we focus on one candle first, followed by the adjacent candle close by, and finally the entire chart. It's rather like a zoom lens on a camera in reverse. We start close in on subject and then gradually zoom out for the complete picture. And that's it for this lesson. This is chapter 4. Next week, we're going to go into volume price analysis, VPA, building the picture. And that's it for our lesson today. This has been session 14. Does anybody have any questions?